Hi subscribers and welcome back to the channel. My name is Dominic James Murray, CEO and founder here at Cameron James. Okay, today we're going to be talking about preparing your pensions in the event of a UK recession. So this is very topical right now. No matter what you read, no matter where you go online, recession, 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 recession. My own personal opinion of this is that we should be ignoring the short-term noise. If you look at, for example, with COVID is still massively rife in many places. Is it in the media anymore? No, no one cares about it. It's boring, doesn't sell headlines, doesn't sell advertising space. We have to remember right now, media is nearly always based on advertising space. Even some of the best institutions, such as the Financial Times, they still have ad space in their publications, even though people pay for the quality of that editorial content as well. Russia, Ukraine as well. Is Russia and Ukraine over? Absolutely not. It's still ongoing, but it's boring now. It's not making the headlines anymore. Now, we're straight on to recession. It is the grabbing the headlines, what gets people worried. Last week I saw, it was actually a BBC correspondent walking around a caravan park in the UK, trying to sort of paint the imagery and the picture of people moving out of their homes to go live in caravans to reduce their rents, energy crisis, talking about a pack of Lurpak. In fact, he even had a pack of Lurpak there as role play. This is all just framing, in my personal opinion. And actually what happened the day before that, the NASDAQ the day before was up 20% from its previous lows. But the commentator, the journalist, didn't mention any of that because it doesn't spark fear in people. Oh, the market's back up again. No one likes to hear that. It's boring. It doesn't really sell papers. But when you have something fearful, people obviously like to sort of buy into it and they get very worried about it. If you have any concerns about your current pensions, should you be doing a transfer, should you not be doing a transfer, just talk to a specialist. But having a conversation doesn't mean you start a pension transfer, but talk to someone who does this day in, day out. Don't try and stay at home and make all decisions on your own or try and understand what's happening in the market. Talk to a specialist. You can do that by booking in below via our description section to have a proper conversation with myself or one of our senior financial advisors. So, on to the topic of how to prepare your pension for the possible UK recession. What I would say to people is trying to time the market or saying to yourself, right, I believe there's going to be a recession, so I'm going to change my entire portfolio. I mean, technically, before a recession, if you move the entirety of your portfolio into cash, let the recession happen, and then you move back to equities again after the recession has stopped, when the markets are at the bottom, you would do fantastic because you would be selling high and you would be buying low. But that is what people have been trying to do for the past 50 years, if not longer. And very, very few asset managers have actually been able to do that over a consistent period of time for say 5, 10, 15, 20 years. Some of the asset managers we work with have managed to do that over the course of time, but the majority of active managers have actually underperformed the market. You would have been better off buying and holding an ETF and holding it over the long term than you would have done working with the majority of active managers who have excessive charges over the past 5, 10, 15, 20 years. So, my advice to clients is it should not be a time to panic during periods of recession. I actually get quite excited during periods of recession because obviously maybe it's my age range, but effectively means, again, not that I personally try to time the market, but when we do see a very large dip in the market, okay, it can potentially be a good time to buy into the market. However, for pension management, it is always about the long term. We're not interested in what happens this month, the next 6 months, the next 1 year. We're interested in what happens over the course of the next 20 years. And we have a lot of clients right now who have got their CTV and they're saying, oh, but I'm not sure, maybe there's a recession coming, or maybe I should just stick with my DB. The whole mindset of that is transferring out of your final salary scheme should not be about the value of your CETV, but for you clients, it is. It is the only thing you can see. What I can tell you now is, as a pension transfer specialist myself and the authorized pension transfer specialists that we use for your reports, they do not really care about the value of your CETV, the multiple, etc. It is not really a factor. Whilst obviously if you were offered 200 grand or 800 grand, obviously there'd be a very large discrepancy and obviously it would be investigated, but it's much more about the suitability of the advice. Is it suitable for you to transfer out a final salary pension scheme in the first place? That's the hurdle you need to cross. Before then you decide, do I want to transfer out or not? You do that after you've already had the report written. So what I would say to people is always focus on the long-term growth. If we look at 5, 10, 15, 20 years, equity markets grow. Equity markets outperform cash. Equity markets in general outperform DB schemes as well. Even if you have 3 or 4% indexation on your DB scheme, equity markets, a balanced portfolio, is growing at typically 7 or 8 or 9% over the course of the past 30, 40 years. If you look at the S&P 500, effectively that's 100% equity, but it's been growing at an annualized rate of return around 10% over the past 30 years. So what you have to look at and say is, forget the noise. Stop looking at the media, stop checking your portfolio on a daily basis. Let the markets do its thing over the course of the next 40 years. The only way that you could challenge that is if you say to me, you know what, Dominic, I disagree with you and I disagree with economists because I believe that over the next 40 years, markets are going to shrink. The world's going to become terrible. There's going to be no growth. No one's going to buy companies. There isn't going to be any sort of mergers and acquisitions. There's going to be no value created in the marketplace. Okay, you're welcome to that opinion, but I personally don't think that's going to happen. I think over the course of the next 30 to 40 years, we're going to see extremely strong growth in the equity markets. If you think previously how difficult it was for capital to find a home to grow. So if you're an investor and you have £10 million and you wanted to invest that money, it wasn't very easy for you to just go and invest companies. Look at how it works now in the US, venture capital, private capital, etc. The way that money flows now to find new projects, all these unicorns that have billion-dollar companies, like you wouldn't have had that 20 years ago. It's happening now because money flows in the correct places. And I personally believe, and I professionally believe, that over the next 20, 30, 40 years, we're going to have very high levels of growth. Now, someone might say to me, Dominic, I'm 2 years away from my retirement. On my retirement date, I have a very large expense. I'm going to buy a holiday home. I'm going to do this. I'm going to do that. I'm going to draw down my PCLS, or I'm even going to take some drawdown of the income as well. And I have a specific goal. In that situation, then, okay, maybe you do need to make maybe a cautious balanced portfolio, or a balanced portfolio at most, not an adventurous portfolio, because you don't have a long period of time until you maybe need to access the capital. But as I would say as a summary for how to prepare your UK pension for a recession, I would say doing this is extremely dangerous. If you already have an account, you should always be talking to your financial advisor. Most reputable financial advisors will be telling you to keep a long-term view and not try to go in and out or time the market, because invariably what can happen is you try to time the market, you come out of the market goes up by 5, 10, 15%. Then you're stuck, because you've just lost out on 5 or 10% worth of growth. Most clients then say, right, well, I'm going to hang on until the market goes down. The market goes up by another 5 or 10%. I know this, I've had clients do this. And then they're stuck because they can't, psychologically, they can't invest back into the marketplace because they're already worried that the market grew without them. So it's very, very difficult trying to time the market. And even if you did say, right, I'm going to go into cash, or I'm going to use a conservative portfolio, then the market drops. Okay? The low point of the market where you should be buying in, typically speaking from history, is when there is the most fear in the market. And I can tell you now, 9 out of 10 clients haven't got the stomach for it. When I email people and say now is probably a good time to reallocate your portfolio, people don't, because they're scared. What they like to see is the market bump up. So when the market goes up by 10%, they then say, oh, now I feel confident, now I want to move ahead. I'm like, well, you've just lost 10% worth of growth. So timing the market is very, very difficult. As a retail investor, it's almost impossible. You are up against people who have all the information in Wall Street, in the city of London. Insider trading doesn't exist. But I mean, insider trading probably does exist in many respects, even if people don't realize it's insider trading. Having a positive feeling by meeting the director or the CEO of the firms, and these guys meet with them on an ongoing basis, just meeting with them for coffee. How's your business going? What's happening? It's not insider trading for the CEO to say, I'm really confident, or actually I'm not very confident about the upcoming quarter, whatever it might be. They're not releasing positive or negative information or results about the company. They're just giving about their product line, what they think is going to happen next. So why try to outsmart and outtime the people who are already trying to do this for a living? With your pension pot, keep it simple. Invest long-term in a risk profile which is correct for yourself, and in 5, 10, 15, 20 years, as per past performance is no guide to future performance, but we've seen equity markets grow, and I believe equity markets will continue to grow. Guys, I hope that's been a valuable video for you today and put some of your fears to the side. Let me know if you have any questions, or if you disagree with anything I've said here, or you'd like me to do a specific video. Let me know any title for a video in the comment section below, and I will do it on my next shoot. Thank you very much, and speak soon.